Are you looking forward to taking advantage of the Forex market and huge opportunities, but you're trading with a small account? Then this video is your meal ticket. In these easy to follow examples, we're going to show you how active traders take advantage of leverage using foreign exchange markets, especially when trading with less capital. Sean Kozak here, tuning in again with Neuro Street Trading Academy. And for the world's best education and trading strategies, make sure you hit that subscribe button. Turn the notification bell on so that way each time we put out content like this, you can get results. Be sure to give me a thumbs up, that way you know you're engaging with us in the content. Now, what I want to do is I want to get right down to the brass tacks. There's certain things professional traders do that novice traders don't. And in our live trading rooms where we're trading Forex with real accounts, there's things that we do that you need to know so that you can put yourself ahead of the curve. And we're going to talk about that in today's video so that you're prepared moving forward. Let's jump on the whiteboard and talk about these topics. So when it comes to real trading, you need to understand the margins in the business set by the brokers, because it's one thing to trade in a sim account and practice, but when you move to live trading, you need to know how to run the business properly at the brokerage level when you're trading real money. So we're going to show you that moving forward. Then we're going to go into the jargon that you need to understand when it comes to Forex account management. Margins, leverage, position sizing, lot sizes, all of that stuff that's critical so that you know what you're talking about. Then we're going to go into leverage and trade size. The number one reason why people use Forex is for leverage, but we want to make sure that you're learning how to size your trades properly so that you can follow good money management and risk management practices. Then we're going to talk about lot sizes, micros, nanos, minis, major lots, minor lots. These things are super important because depending on how much money you're trading with will determine the size of lot trades that you take. And then the last thing I want to do is I want to give you some free websites that we can use to be able to size your trades properly so that you're never over leveraging yourself and you can last the long game in the markets, because this game is about money management and risk management over and above trade strategies. And this video is going to be your meal ticket for understanding how to take advantage of leverage properly. So let's jump onto the charts, traders, and get you started. Welcome back, traders. We're going to get started here on the final video for Forex Explained Part 4. Now, this is going to wrap up our intro series on getting started in the Forex markets. And today's topic, we're going to be talking about leverage and margin. And this is a really interesting topic because that's why a lot of traders are actually, excited for Forex and also kind of attracted to the Forex market to get started. And what we'll do is we'll talk about that so you got a better understanding of why that is, right? So First and foremost, we want to ask ourselves, what is Forex margin? Forex margin, just like futures margin, is a good faith deposit, right? Because unlike stocks, where you're borrowing money, right? Forex is already a leveraged asset. It's already a leveraged instrument. So really what we're doing is we're putting money aside in escrow as collateral to initiate the trade. The same thing with the futures markets. And essentially, it's the minimum amount that a trader needs in their account to open a position. This is usually communicated as a percentage of the notional value trade size of the trade. The difference between the deposit and the full value of the trade is considered borrowed from the broker. So what we're doing is we're essentially pledging a little bit of our money to basically say, hey, Mr. Broker, can you help me borrow me the rest of the money so that I can associate getting into a trade here and putting money into the market. Now, a good example, to the right is a visual representation of Forex margin requirements relative to a full trade size. And sometimes you'll have margin expressed, in different percentage levels. Like sometimes you'll have different margin requirements depending on the broker. And give you an example. Let's say the trade size is $10,000 and the margin requirement is 3%, 3.33%. What this means is you have to put a cash deposit of $333 in escrow on the side in the account so that you can establish that trade. Now, it's important to understand that the margin needed to hold a position open will vary depending on the trade size. And if you increase your position size, the margin requirement will also increase. No different than if you were to do that for futures, etc. The more money you put, the more contract size or more market size you have in a position, is essentially the same. You know, in Forex, you have to also make sure you have enough money in your account to hold that position on escrow. So make sure you understand the market you're trading is a big part, right? You want to make sure that, because every broker to broker varies and every pair varies based on the margin, right? One thing to remember that, you know, with margins and economic reports, brokers actually reserve the rights to increase margin requirements during these reports because of the news announcements. This is due to the volatility and the exposure to risk. Okay, so let's kind of break down some terminology so you understand some things. Equity is the balance of your trading account after the current profits are subtracted from losses of the cash balance. Okay, your margin requirement is the amount of money on deposit required to take on a leveraged position. Used margin is a portion of the account equity that is set aside to keep the trade open, also known as maintenance margin or excess margin, right? The margin call, this is when a broker executes a phone call or executes your position because you basically breach their requirements and you don't have the ability to ultimately keep the position on. The Forex margin level, this provides a measure of how well the trading account is funded. So definitely you'll have different margin levels based on, you know, how much liquidity you have. The leverage is basically the tool that we require to basically take advantage of the exposure in the market. And that's one of the reasons why a lot of traders are, you know, attracted to the Forex markets, is because of the leverage. Free margin is the equity in a trader's account that is not tied up in margin so that you can open up more trades. So if you're taking on more than one or two positions, this is something that you want to do here so that you understand that you need excess margin in your account, aka free margin, so that you can ultimately put on more positions. So a good example would be if you had equity of 10,000 and you have margin allocated to a trade of 8, you could actually take on another trade up to 2,000 in margin as long as you don't breach that. They'll liquidate your positions, right? So it seems like a lot to learn, but it's just terminology, just jargon. You know, these are basic terms, you know, and for the most part, everything is very straightforward. It's just good to understand it, right? As you start getting experience in this market, you start getting yourself familiar with the trades. Remember, with trading in simulated accounts, a lot of times traders don't remember about the margins until they move to live trading. So you definitely just want to make sure that you're aware and you're in tune with, you know, the difference between fake accounts in a practice environment versus sim accounts and versus live accounts, right? So, because once you move into live trading, this is where margin actually becomes a realized factor for you, right? And understanding those metrics. So let's kind of talk about the leverage. So the connection between margin and leverage. So before continuing, it's important you understand the concept of leverage. Leverage and margin are closely related, but because the more margin that is required, the less leverage traders will be able to use. This is because the trader will have to fund more of the trade with his own money and therefore is able to borrow less from the broker. So, you know, you have different leverage ratios like margin requirements. As the margin requirements drop, you actually increase your leverage, which means you have less, the brokers require less margin, which therefore gives you more leverage in the position. So what does this mean? A small investment can produce a large profit, but it can also produce a large loss. And take note that margin and leverage can vary between brokers and will differ. And you want to make sure that different regulatory requirements, different pairs, different countries, different regulations, different industries or market environments will basically dictate different terms. So just make sure you check with your broker, your jurisdiction, wherever you're trading, Canada, Euro, Asia, Australia, US, wherever you are. Just make sure you got a handle on who your broker is, what their margin requirements are, what their leverage opportunities are. And you'll notice here that you can sometimes get 30 to 1, 50 to 1, 100 to 1, 200 to 1. A good example of leverage to margin and also that exposure, let's say you deposit $1,000, right? And you have 10 to 1 leverage, okay? Ultimately, if the position goes up 5%, you make $500. It's 50%, right? If the asset moves 5%, you're actually making 50% on your money. If the asset loses 5%, you're losing 50% of your money. That's a 10 to 1 leverage. But if you were only at zero leverage, which is a traditional investment, right? Moves up 5%, you make $50. Moves down 5%, you make $50. So you can see the power of a 10 to 1 leverage, right, on just $1,000. Which is very, very, very easy for the markets to move several percent in a day. So just be careful with that because a lot of traders think that leverage is your friend. It can be your enemy if you're not specific around risk. So let's kind of talk a little bit about leverage in Forex versus leverage in stocks. Okay, Forex leverage differs to the amount of leverage that is offered when trading shares. This is because Forex pairs are liquid and typically exhibit less volatility than even the most frequently traded shares. As a result, hedging risk and getting in and out of trades is more manageable in $5.1 trillion on a daily FX market, right? So how is Forex leverage actually calculated? That's the more important question. Well, what we do here is we're going to be looking at the notional value of a trade, which is aka the trade size, and the margin percentage. Brokers will often provide traders with a margin percentage to calculate the minimum equity need to fund the trade. So I'll give you an example. Your equity, okay, equals your margin percentage times your size. So leverage is your size divided by equity. So if the trade size is 10,000 units of currency and the margin is 10%, right? Margin times trade size equals equity, okay? So you need $1,000 for that position. The leverage would be 10 to 1, okay? Now, the main thing here is not to get too concerned about this right out the gates. Most traders are going to start with small size and work their way up. The big thing here is just making sure you always have enough margin in your accounts to take on the positions and you're not over leveraging your size. So a couple things here. This is kind of a more in-depth slide, so we're going to talk about this in a little bit more detail. I'm going to slow down and read this to you. Every FX trade is placed by selecting a number of lots that you want to trade in the market. The most beginners don't realize is that your position size is dependent not only on your equity, but the margin requirements set by a broker and the leverage available to you, but it's also heavily dependent on the actual currency pair itself. This has to do with the volume and the exposure of the market. Some pairs will be more expensive to trade and some will be less. So an example here, let's say you have a $10,000 trade on the pound dollar, and you are allowed to trade a specific number of lots. However, you may also place a $10,000 trade on the US CAD. You will be trading different lot size dependent on the notional value of that position, right? Because those are different pairs. So therefore, you may be thinking that you're still holding the same position, but it's not. So the first example, you're going to be buying $10,000 or a $10,000 size position on the pound dollar at 1.2421. This is buying 10,000 pound and you're selling $12,421, okay? Now, this basically means that you're buying 10,000 pounds and selling the equivalent in US dollars, but the quote states that we had to sell more US dollars to purchase the pound. This means the notional size is always going to be worth the quote currency because you're using that to purchase your base. Or vice versa, right? Now, on the other hand, the exact same position of 10,000, okay, to get the US CAD, this translates to buying 10,000 of the US base and you're selling 13.6 of the CAD. Well, this means you're buying that and you're selling the equivalent in the CAD dollar, but this means that you had to sell 13.6 of the CAD dollar to purchase that. Now, you're going to notice that this is basically more currency because the notional size of this is actually more than, say, of the pound dollar. So this is actually a larger position. You're still buying $10,000 worth of the dollar, right? But you're buying, one is you're buying 10,000 worth of the pound. The next one is you're buying 10,000 worth of the dollar, but the US CAD position is actually worth more currency value-wise, right? So this is an important lesson to understand because it can make a big difference in how you manage your overall account. Example, if you wanted to spread your money over a couple different trades, you just want to make sure that you understand your position sizing. Now, when I first learned this stuff, I was actually overwhelmed. I said, this is just so much to think about, so much to learn. If you're listening to this video, I want you to take a step back and say, okay, what does all this mean? Well, we've got tools and we've got resources where you don't even have to worry about all that. You just simply plug in the numbers and it's going to tell you your size, it's going to tell you your risk, and you can actually just sleep well at night. But, it's kind of like going to law school. Just because you study doesn't mean you use all of the theory in active trading all the time. It's good to know, it's good to understand it, but it doesn't necessarily mean it's going to translate into the way we actually facilitate trades every day, right? I'll give you an example. If I'm sitting here getting ready to take a position here, okay, if I'm sitting here getting ready to put a position here,
order submitted
down here and buy a position, am I sitting here worrying about, what's going to happen on the broker side and I'm going to worry about all this other stuff, right? No, I'm just worrying about, taking a trade and getting into the market. But the other side of it is that, well, what if I'm, should I be trading 20,000? 30,000, 100,000. Like, should I be trading a full lot, a big lot?
Order submitted.
Right? A regular size lot, a micro lot. These are what's more important to what the discussion is.
Order
And
canceled.
so that's kind of what we want to do here. We want to talk a little bit about why this is kind of the conversation from this example will translate over into some more relative and more important discussions for active trading. When you talk about Forex, right, rather than talking about the size of the position, we need to understand what that means in terms of the lot sizes, because that's how you position size your accounts. We're not sitting there trying to worry so much about, the overall exposure on that more than, your trade by trade risk size. And so what we do is we have different lot sizes. Standard lot is 100,000 base currency units. A mini lot is 10,000 base currency units. A micro lot is 1,000 and a nano lot is 100, right? And that's really how you position size your trades. We've actually got real money management tools that we've designed for NinjaTrader that can do this for you. If you're not using NinjaTrader, you're using TradingView or any of the other platforms, you can actually use web versions. So there's some examples of this. You can use position sizing tools. This is just something that I found to be very intuitive, very easy to follow. And this is Baby Pips. It's a website. It's a free tool. The following are some online resources. It's a great starting point for using this. And this will help you position size your positions, right? So the pip value calculator, we can do this together as an example, because sometimes traders will often get overwhelmed with the Forex calculations and trying to understand a position size. So what I'm going to do is I'm going to show you some websites here for a second. We're going to just go to Baby Pips. Babypips.com. These are tools sections. If you go into the tools, you're going to see that there's tools here. You can gain loss percentage, pip value calculator, position sizing calculator. That's the ones we're more focused on. Okay. And it's really the pip value calculator that you're going to look at here. Okay. So we can look at the pip value. Let's go to that here together. And also the position sizing tool. So the position sizing calculator. So let's kind of go down here, right? Let's talk about the pip value. What's the valuation of this market? So the asking price, okay, the asking price is if we're looking at the currency pair, well, which market are we looking at here? We're looking at the Aussie dollar. So let's go in here and we'll just take a look at the Aussie dollar. Let's go down here, right here, Aussie dollar. And the asking price, what's the asking price? The asking price right now is 0.7276. Okay. So if I wanted to put in, let's say, 100,000 units, one standard lot, calculate that in currency. That's 10 pips. So that's 10 valuation pips. And basically, it's a 10 pip value against the account currency of US dollars, right? But this is not so much more important to me as the position sizing, right? The position sizing is really where the active trading gets involved. And this is where I really think that you're going to spend more of your time. Let's say you're trading with a $10,000 account, okay? You're trading a US dollar account and you want to trade the Aussie dollar. So you come down here to the Aussie dollar, okay? And let's say you want to risk 1% of this. And your stop loss is in, if your stop loss, let's say you wanted to have a position here. Let's just go over here for a second. Let's say I wanted to get into this position right here. I wanted to buy this support level right here. And I wanted to have a stop loss from 71 to 78. So that's a 8 pip stop, right? So 7 pip stops. Let's say 7 pips. Okay, calculate. Basically, the amount at risk is $100, right? You can see it's one standard lot. Okay. 14 mini lots. Okay. Or 142 micro lots. It tells you right here how much you're positioning, how much dollars that you have $100 at risk. Right? You're risking 1% of a $10,000 account. I can go in with 1.4 standard lots. So if I were to simply put in here, my risk percentage, and I wanted to go in here, if I wanted to put on a position here to here with my stop loss, and I wanted to go long and get out of here, from here to here, 1.4 standard lots would give me $100 risk on this trade. Right, and that's really where you're more worrying about what we're talking about today on notional value, rather than worrying so much about,
you know, all the other stuff that's the theory that can overwhelm a lot of new traders. And so these are some resources that are for free. Very easy, very intuitive, very simple for you to learn. Keep those on your browser. You're more so going to be worrying more about the position sizing calculator, not so much your pip value calculator, but that's really good there for you to use. So let's give some examples, right? I want to buy too many lots of the Aussie dollar at 105 and sell too many lots of the Aussie dollar at 106. Therefore, you have the mini lots is 2. That's the size of the position. And then leverage is 1-to-1, the multiplier for the account, right? That's the leverage. And I'm requiring 20,000. The requirement on this account would be 20,000. And the profit in pips is $100 or 100 pips, which is the distance the trade moved, right? So I'll give you an example. This would be a $200 profit in the game, right, with a $20,000 pledge. But here's the issue. This is a 1-to-1 leverage, right? So you're buying too many lots or selling too many lots and the market moves. There's no advantage here, right, with a 1-to-1 leverage. With a 100-to-1 leverage, the same position, you're only pledging $200 margin on this trade. The same distance, but you make $200 in profit. It's a 100% return on your money. You're pledging 200 to make 200. Yes, it's on leverage, but you can see the reason why Forex is so appealing. So the profit is the same. However, the margin requirement to tie up your capital was only $200. So the return on your investment becomes very important. So just think of this as a very, very good lesson that leverage can be your best friend or your worst enemy, especially with trading Forex. You want to be aware of the margin calls. Make sure that you're not over leveraging your positions, not going into too much, guns blaring, trying to be right about everything. Just focus on getting good first and in learning our strategies and coming into our classrooms and asking great questions. And that's where the magic's going to happen, right? This is a good theory. It's a good starting place for you to get involved in Forex and getting a terminology and stuff like this. But just make sure that you understand what this means and you know what a margin call is. A margin call is when you breach the margin requirements for the trade. The brokers can liquidate your positions. And just make sure that you're not going into those types of environments, right? You're aware of your account. And most people are trading on sim before this ever becomes a reality for them. And your sim accounts are ultimately simulated accounts for you to practice in. And if you're having problems in a sim account, you should never move to a live account, which is why we practice at a school level, right? So you should never ever. I've been trading 10 years. I've never had a margin call, right? You should never have a margin call. So this is just really important to you to learn that it's not necessarily going to happen as long as you follow your rules and stick to your plan. So the last thing I want to talk about is price limits and circuit breaker halts. In the stock market and the futures markets, this is very, very, very relevant. There's thresholds in Forex as well. And the big thing here is the whole purpose of these circuit breakers or these halts, we call them limit up or limit downs, is whenever the markets have massive pandemics, Black Monday, COVID-19, flash crashes, 2018 crash of the market, and these types of things, the market gets erratic. And when the market gets erratic and the market gets out of hand, panic sets in and the market says, we need to take a breather. So they shut down the electronic exchange. They don't allow trade to take place. They give everybody a break. Everybody kind of calms down, gets their bearings, and they facilitate trade again. They open up the market. So, we've seen this recently. The time of filming this video, we just went through the pandemic COVID-19 crash. I seen this in the 2018 market crash of the U.S. market housing environments. But the main thing here is that just not get caught off guard. You'll know when the market's getting a little bit extreme. Fundamental reports don't even stop the market. So, the only time you're going to have these are in global crises. But it's just good to know that these are there as well to kind of hedge the risk on the entire industry, right? So hopefully you learned something. Hopefully you found this beneficial. I find the Forex market to be, a great place for new traders to get started. As with all of our courses, the stock course, the futures course, now the Forex course, the options, the cryptocurrency course. These intro courses are really designed to help you get a good foothold in getting started. But by no means is it going to be the end-all be-all for you. These intro courses are your starting point, and now your next step is going to be moving into the education courses and into the add-on sections to learn about the indicators and the strategies, and then into the live market so that you can actually learn our strategies, learn how to trade, and join us in the live class where the real magic happens. So if you haven't done so already, get on board those education courses so we can help you become a great trader, and we'll see you in the live markets. Take care, traders, and have a great evening.
Welcome back, traders. Now, I know you found a lot of value out of this content because this video is super critical to your success. But make sure you don't forget the other videos in the series. Click the links below so that you can take advantage of those moving forward. Last but not least, hit that subscribe button and be sure to share this video with a friend. That way they can get the same results you're looking to achieve as well. Now, make sure if you have any questions or you want to get social with us, leave them below in the chat box so that we can help you moving forward. And be sure to check us in the next video. Take care, traders, and happy trading.